So let's say you're buying an investment property for the first time. What is there to consider? Well, of course, what kind of property you're going to buy, whether you're going for rental return, capital gain, or super gain. All right, I'm going to talk a lot more about them. But in terms of how you do it, your home loan is a loan that you service with your after-tax dollars and is not tax deductible. You do not want to pull anything out of that offset account for any use where it's tax deductible in any way, whether it be for business or your investment property. So normally, what you would do when you buy an investment property is you would want to borrow 104% of the purchase price. That's the full amount plus the stamp duty. In fact, if you're going to buy an investment property and spend $20,000 on a new kitchen as soon as you buy it, you would borrow 104% plus the $20,000. Anything that you spend that's deductible, create a new loan account. Don't go messing with your offset account against your home loan and increasing your after-tax home loan, yeah? Very, very important. So if you were to buy a property worth $1 million, you might want to borrow the 24% against your home. So we set up Loan B for 24% of the purchase price, and then against the investment property, we do the 80% loan against the purchase price. So you've borrowed 104%, but you've kept them separate. Don't get fussed that Loan B against your home loan is secured by your home. What makes a loan tax deductible has nothing to do with what the collateral is, okay? It's got to do with the money trail about what you actually use the money for. So people like doing that so they have a cross-collateralized agreement. There's my home, there's my investment. Your 24% loan and your 80% loan don't even have to be at the same bank, right? You still owe 104% of that investment property. If you go and buy a car and you get to claim that through your business, let's say we did one for a real estate agent the other day, we did Loan C, $50,000. Don't just drag the money from your offset account or from your business account. Anything that you do that's tax deductible, please borrow it. And I said to the real estate agent, why do you want to go and get a Chattel mortgage and pay this car loan off over 5 years and pay $50,000 into something that is tax deductible, right? I would much rather keep the car loan of Loan C interest only, or at least stretch the term to 30 years so it's just about like interest only. And instead of paying $50,000 into your deductible car loan over the next 5 years, throw that in your home loan, right? Also, car loans really affect your ability to borrow. The capacity to service calculators are so affected by car leases, HECS, personal loans and credit cards. So I'm a big fan of stretching things out to 30 years. Anyway, I wanted to explain that. Thanks for watching. I talked for too long. Far out.